How does BNY Wealth help accomplished individuals, families, and business owners achieve their financial goals? They start every conversation with the question, what do you want your wealth to do for you? For over 240 years, BNY Wealth has partnered alongside their clients, putting their expertise and proprietary solutions to work for them. The result? Highly satisfied clients and enduring relationships that span generations. To learn more about how BNY Wealth can help power your wealth goals, subscribe to their podcast, Your Active Wealth, where they offer guidance for building and sustaining wealth in any market.
You can get the news whenever you want it with Bloomberg News Now. I'm Amy Morris.
And I'm Karen Moscow, here to tell you about our new on-demand news report delivered right to your podcast feed. Bloomberg News Now is a short 5-minute audio report on the day's top stories. Episodes are published throughout the day with the latest information and data to keep you informed.
Yes, there are other products like this from a variety of news organizations, but they usually rerun their radio newscasts throughout the day. That's not what we do. We create customized episodes that can only be heard on Bloomberg News Now.
And we don't wait an hour to publish breaking news. When news breaks, we'll have an episode up in your podcast feed within minutes, so you're always getting the latest stories and developments.
Get the reporting and the context from Bloomberg's 3,000 journalists and analysts. We're all over the world. Listen to the latest from Bloomberg News Now on Apple, Spotify, or anywhere you listen.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, we look ahead to how commodities may fare in 2026, along with an outlook for the housing sector. I'm Nathan Hager in Washington.
I'm Stephen Carroll in Brussels, where we're thinking about the culinary and cultural trends in Europe to watch in the year ahead.
I'm Doug Krisner, looking at the possible timeline of a rate hike from the Reserve Bank of Australia.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager, and we begin today's program with commodities, a sector that presented a mixed, but for the most part, strong performance in 2025. So for more on what to expect in 2026, who better to be joined by than Mike McGlone, Senior Commodities Strategist for Bloomberg Intelligence. Happy New Year, Mike. And what a year it was for gold, trading at records. Is 2026 going to be another year to be a gold bug?
Unfortunately, the lessons of history, Nathan, say the momentum's upward, but history suggests this is where overweight, long, new positions typically underperform, particularly for enduring pairs. To give you one example, gold's cousin, silver, it's gone, they both had the best year since 1979. In 1979, silver's high was 32. This year's low was 28. That's almost 50 years. So that's the kind of risk you have with gold getting this level. So I think momentum probably gets it towards 5,000, but a normal back and fill of a high velocity rally like this can actually get it to 3,500. So I put frightening and gold in the same sentence because I'm just absolutely frightening. When gold grabs alpha like it did this year, beats everything, particularly beta, the stock market, I get worried. So to me, what's commodities are telling us this year, it's been basically a ho-hum broad commodity market. The Bloomberg Commodity Index has basically tracked the S&P 500. It's the interworkings, like you mentioned, but gold going up at this velocity, over 60%, and crude oil going down about 20%. That disparity is the widest ever. And so it's around 80, 90% in 2008. The previous extreme is 60%. So I'm really concerned what this is telling us when the most significant ancient store value grabs alpha and the world's most significant industrial commodity goes down.
Yeah, let's talk a little bit more about that disparity because to your point, we did see oil prices pretty subdued in 2025. What do you see driving the oil market this year?
Well, the key thing for oil to think is to look back from the future, and that's the peaks in 2022, shifted the world order, kicked in EVs, brought on that all that rapidly advancing technology, which brings on more supply and reduces demand. And now we're in the downward cycle from that. So typically takes a low price cure. So WI crude oil has the high for this year is around 80 or so. It's got down around 55. I think historically the lows have been around $40 a barrel, and I think that's going to happen in the 2026 year, but it can also easily pop to $70 a barrel. 70 bear markets are notorious for sharp short covering rallies. So the one thing I really think we're going to have next year is a decent amount of volatility in all markets, particularly the stock market. I think crude oil is going to continue heading lower, but it's not alone, Nathan. It's in the same camp as corn, soybeans, and wheat and the grains, and they're all on the back of going up too much, to speak, in 2022 and going down now. And that's the key thing to remember in commodities. They go down because they went up too much. Typically, that's less so the case in things like gold, but particularly, most notably, the elastic commodities. So here's what I'm really worried about. If crude oil continues lower like this, which I expect, and we just get a little backup in the stock market, that's a pretty significant post-inflation deflationary force, which is a matter of time. And just one example of that, that's what's happening in China. That 10-year yield in China is about 1.83% versus above 4% in the U.S.
What about the energy demand from artificial intelligence? Does that play anything into the oil market?
Yeah. Right away, start with silver and copper. When you think of energy demand, electricity transmission, and conductivity, the two top commodities for that in terms of metals are silver and copper. And guess what? They're some of the best performing commodities this year, but for different reasons. So not so much worried. And if anything, for electricity demand, you tilt over to natural gas. Natural gas is back down below 4 in the year. The high is 5.5. And almost every time it gets above 5, it goes back down below 4. Why? It's the elasticity of supply in U.S. natural gas is one of the most significant forces in all energy, particularly in natural gas. So oil is the key thing, but oil is being replaced by technology, and that part of that technology is what's keeping bid things like copper and silver. But the key thing also remember, copper, it was a supply constrained year, and I think copper is the number one wild card next year. And if it goes down, which I'm afraid it will, like the stock market, that's a sign of deflationary dominoes falling on the back of crude oil and iron ore in China and bond yields in China. So the bottom line is you have to tilt over to China. Can they come out of this malaise paired with a significant demand pull economic recovery, facing tariffs from the rest of the world, not the U.S.? I think that's unlikely next year.
So given all these dynamics, Mike, what do these moves in commodities suggest to you about the economic outlook for 2026?
It's the velocity of this rally in gold being the highest in almost 50 years, and certainly versus crude oil, is a clear global recessionary trajectory. The key question is what stops it next year. Now, gold is clearly stretched versus almost everything, with the exception of the U.S. stock market. And that you would expect when we have the paradigm shift of the world's most demand pull, significant importing country, putting the kibosh on the rest of the world trying to export to the U.S., most notably China. Now the rest of the world's actually pushing back on China exports because they're exporting deflation everywhere. So to me, the signals for commodities are we're in a global deflationary trajectory, and the entire pillar of the whole world is resting on the U.S. stock market. It's a little bit less so, but still the highest valuations versus most rest of the world. Let's look at the MSCI World ex-U.S. Index and versus GDP in almost a life, and certainly almost 100 years. So that to me is the risk that we tilt lower, and just a little pickup in volatility. So I'll end with this. We've never had a rally in gold with this velocity. Like I mentioned, it's almost 90% above its 60-month moving average, with volatility in the stock market this low. So 120-day volatility in the stock market has reached around 11%. The average is usually 17%. So I'll make a prediction. We're going to rally back up and get to normalization in stock market volatility next year, and that might be that deflationary signal that you're getting from commodities. But that's the kind of thing I'm really worried about. I'm frightened. We've never rallied this much in gold without stock market volatility going up.
All right. Well, we'll see how that prediction shakes out. Thanks for this, Mike, and Happy New Year once again. That's Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. We move next to the housing sector. In 2025, it experienced a significant cool down with high mortgage rates and home prices still lingering. So what can we expect from real estate this year? Let's bring in Bloomberg Intelligence U.S. home building analyst Drew Redding for some answers on that. Drew, I think a lot of home buyers are hoping for lower interest rates in 2026. Could that spark kind of a turnaround in the housing sector?
Yeah, you're right. There's been a lot of optimism that the pullback in rates to that low 6% range, would help affordability and spur a lot more activity. What's interesting and what we've heard from some of the builders is that there hasn't been a material increase in demand since rates pulled back. And I think, one of the problems is that there's just a lot more uncertainty out there in the market. There's concerns over the general direction of the economy, more concerns about the outlook for the labor market. So people are putting off these big discretionary decisions. When we talk about the resale market, we've kind of been hovering in that 4 million annualized pace now for a couple of years. I mean, the market's really been frozen, but we do think that we'll start to get some growth in 2026, albeit off of that low base. We'll have more inventory on the market as long as rates, continue to play nice in that low 6% range. We should be able to see some growth with prices moderating as well.
So where do you see prices going specifically? And do you think that we're going to see improvement across the home building sector? Is it going to be in luxury, or can it be in sort of the low to mid range as well?
So in terms of prices, I think in the existing home market, you're going to see a moderation maybe into the low single digit range. In the new home market, we actually think you're going to see net prices continue to come down, just because, builders are shifting their product mix, they're continuing to lean on sales incentives. Now, in terms of how we're looking at the new home market next year, from a broad industry perspective, we think that the single family market is going to remain muted. We're expecting housing starts to be lower in 2026. And it's really a reflection of, the soft demand environment we've seen, as well as the fact that inventory levels in the new home market are the highest they've been in a while. So there's not a lot of incentive for the builders to put new product into the ground until they work through that spec inventory. And I think it's going to take time. Now, we do think that you could see a modest improvement in sales. Of course, lower rates certainly help, but that's really a reflection of the fact that builders are growing their community count. So it's not necessarily a pickup in sales pace, which is similar to the concept of same-store sales. But like I said, I think the group's going to continue to lean on incentives to support those sales. So we do think prices will moderate from here.
A lot of what I'm hearing from you makes it sound like for a lot of these new home builders, margins are going to continue to be sort of squeezed into 2026. Is that what you're thinking?
Yeah, you hit the nail right on the head there. I mean, the fundamental backdrop for the public builders, we think, remains challenging in 2026. We're expecting to see further earnings declines due to, soft top line growth and, as you mentioned, further margin pressures. And the reason for this is that many of the home builders heading into 26 will have backlogs that are significantly lower, anywhere from 10 to 40%, depending on the builder. So that's going to put pressure on closings. Like I said, there has been a fair amount of optimism that the pullback in rates would help, but we haven't seen that meaningful turn in demand. And because of that, to your point, builders are going to have to continue to lean heavily on incentives. We had a recent report from the National Association of Home Builders, which showed that the use of sales incentives is the most widespread that it's been in the post-COVID area. Now, that's primarily mortgage rate buydowns, which have really hurt builders' margins, but we're also starting to see outright base price reductions. So those things combined are going to keep profits muted next year.
And what could all this mean, Drew, for home builder stocks? It sounds like it could be a pretty challenging environment for their valuations in 2026.
From a pure valuation perspective, it's not overly compelling. There's an old rule of thumb in the industry that says you buy the builders at 1 times book and you sell them at 2 times book. That's not to say they've never breached those thresholds. So I think you really need to, when you talk about the stocks, kind of split it out between the large cap builders and the smaller cap builders who are trading at much more of a discount than they have historically. That being said, though, I think there's still a cloud of uncertainty over the industry as to whether demand picks up, whether housing policy has an impact next year. So I do think that there are certainly some headwinds.
All right. Well, really appreciate this outlook on where the housing sector could go in 2026. Drew, thanks again for being with us. That's Drew Redding, U.S. home building analyst for Bloomberg Intelligence. Coming up on Bloomberg Daybreak Weekend, we'll look at the culinary and cultural trends in Europe to watch in the year ahead. I'm Nathan Hager, and this is Bloomberg.
How does BNY Wealth help accomplished individuals, families, and business owners achieve their financial goals? They start every conversation with the question, what do you want your wealth to do for you? For over 240 years, BNY Wealth has partnered alongside their clients, putting their expertise and proprietary solutions to work for them. Institutional investors embrace principles that help build wealth consistently over time. BNY Wealth's multidisciplinary active wealth approach employs these time-tested principles to help ensure that every financial decision actively and intentionally powers their clients' goals, while uncovering opportunities that may have been missed otherwise. The result? Highly satisfied clients and enduring relationships that span generations. To learn more about how BNY Wealth can help power your wealth goals, subscribe to their podcast, Your Active Wealth, where they offer guidance for building and sustaining wealth in any market. Again, that's Your Active Wealth.
I'm Carol Masser.
And I'm Tim Stenivek, inviting you to join us for the Bloomberg Business Week Daily Podcast.
Now, every day we are bringing you reporting from the magazine that helps global leaders stay ahead.
We've got insight on the people, the companies, and trends that are shaping today's complex economy.
That's right, Tim. We're all over global business, finance, tech news, all as it is happening in real time, and we've got complete coverage of the U.S. market close. Gotta say, basically, if it impacts financial markets, if it impacts companies, if it's impacting trends and narratives that are out there, we are on it.
We also have a lot of fun doing it. Bloomberg Business Week also brings you the analysis behind the headlines through conversations with our expert guests.
And we are doing this all live each weekday. And then we bring you the best analysis in our daily podcast.
Search for Bloomberg Business Week on YouTube, Apple, Spotify, or anywhere else you listen.
Check it out on your way home from work to catch up on the conversations that you missed during the business day.
And on the weekend, check it out for a complete wrap-up of your business week.
That's the Bloomberg Business Week Daily Podcast. I'm Carol Masser.
And I'm Tim Stenivek. Subscribe today wherever you get your podcasts.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in the program, we'll look at what's in store for monetary policy in Australia for the year ahead. But first, it's been a roller coaster year for the global economy. Even amid all that turmoil, though, we did find time to relax, explore, and share a meal. The hospitality industry's had another challenging year in many places, but there are still plenty of dining, travel, and cultural highlights to reflect on and look forward to. For more on that, let's go to Brussels and check in with Bloomberg Daybreak Europe anchor Stephen Carroll.
Nathan, the worst of the inflation crisis is behind us in Europe. The European Central Bank looks to have finished its rate-cutting cycle, and rates have come down significantly from their peak in the UK too. But many consumers are still feeling squeezed by the higher cost of living. In the UK, surveys have shown Brits cutting back on dining out in the past year. All of that being said, many restaurateurs actually reported an upturn in bookings towards the end of the year, showing a continued appetite for experiences and a little indulgence as well. To help us unpack the latest trends in eating, culture and travel, I'm joined by the dream team from Bloomberg Pursuits, our food editor Kate Crader and UK correspondent Sarah Rappaport. Great to have you. Kate, I'm going to start with you. I know you've been keenly watching the big trends from food scenes globally this year, but from a London point of view and from sort of the big business point of view, has it been a good year for restaurants in London?
That's a really good question, and it definitely depends on who you ask. I think that some of the big recognizable names will tell you that it's been a really good year, and they haven't seen that much fallout, despite, as you said, the there's continual budget woe news, and it definitely seemed like it was going to be a very un-merry Christmas. So it was actually like some good news. I love an optimistic headline, and it's amazing to know that a place like Hawksmoor, the fantastic UK British steakhouse chain, they saw 16% increase in bookings from last year. Will Beckett told our own Bloomberg TV team. But I live in South London, and there's this fantastic little restaurant across the street from me called Lagare that I love. Shout out to Lagare. and they're having a challenging year. Like, they were trying to decide whether to open the week after Christmas just to try and make some money back because they've lost a lot of money on booze sales because people have cut back on drinking so much. So it's definitely a mixed year, but I want to be optimistic and say yay for all the places that have seen an increase in sales.
And if you haven't already guessed, this is a conversation for which you may want to be taking notes for recommendations for what to do in the future as well. Sarah, let's turn to you. In the past year, you've covered everything from high-end property to top-notch travel destinations and more as well. What's your reading on where the travel industry is now?
It had a few years after the pandemic where everyone was doing the whole revenge travel thing. People didn't care how much money they were spending. Borders were open. They were just wanting to go out and do the YOLO vibes, have a good time, right? So they didn't have to try too hard to really differentiate themselves in those first few years after the pandemic. But things are changing now. The situation's getting a little bit harder. And at the top end, at the ultra luxury end, things are doing all right, but the middle's a little bit more squeezed. So that's where we are now, and that people are having to really decide more about their budgets, how much they wanted to spend on travel. Whereas before, 2021, 22, like, put it on the credit card. We want to go somewhere. Now things are a little bit different.
Okay, and that's, I suppose, making it everyone a little bit more discerning too and how they're putting forward their offerings as well. Let's talk a bit about highlights of the year then. Kate, what meals have really impressed you in the past year?
It's been an interesting year. London was like a bit on the quiet side in the restaurant scene, relatively speaking, because when it's good, it's so great. But as Sarah was saying about travel, I think that echoes in the restaurant industry. One restaurant that opened that I absolutely loved, maybe because I'm a New Yorker, is called One Club Row. It's in Shoreditch, and it's actually like a sort of two-level. It's one of those places that occupies an old pub, and old pubs are so beautiful, and smart restaurateurs know that. On the first floor level is a place called One Club Row, and it's got these New York vibes. It's a bit of a steakhouse. They have a burger that's a very good burger. They have a jamming martini menu. Martinis have been a big trend this year. Everybody has a martini menu. Like, if you hear that people aren't drinking, just look around at all the martini menus and think again. So a huge shout out to One Club Row. Borough Markets just also continue to be fantastic. And then West, Notting Hill's having a very good year restaurant wise, and a place called Dove from a very great chef, Jackson Boxer, opened, and they too have a burger that I think is one of the best burgers I can remember having, and I've eaten a lot of burgers.
I see. I like the idea of a staple doing well as well. One of the pieces that I really enjoyed that you wrote in the past year was about the question of experience, and it not perhaps just being the food that makes a great meal. With your great experience and with your expert hat on, Kate, what is the architecture of a great meal? What impresses you when you're going out to eat?
I love that question, Stephen. Yeah, no, I got to write about, this was based on a New York meal, but I'm wondering how much food matters anymore in this world of experience. And Sarah knows that from travel too. I think when you go somewhere, you can have a great meal, but if the service isn't good, and or if there's not something that captures your attention or makes you feel like, wow, I'm really here. Like, this is something, this is why I'm paying this money, because it's not something I can do at home. It's not something I can do anywhere else. It can be something as simple as a good trolley. I mean, trolleys have rolled around dining rooms for a really long time. But if someone does a really good job of parking that trolley at your table and then serving you some food in a way that makes you feel special and makes you feel like this is a singular experience, then it's going to stick in your mind. It's going to play big on your social media. Like, it just is such a winning trend on so many ways. And someone who said that for a very long time is Danny Meyer, who's the founder of Union Square Hospitality and Shake Shack. And he's a hospitality genius. And he's been saying for years that you can have bad food and a good experience, and you're more likely to come back than if you have good food but bad service and not a great experience. So everyone remember that.
The trolley thing is so true. As soon as you said it, I could picture 2 or 3, for some reason all cheese related, we'll come back to that later, that I can remember as standing out for me as well. Sarah, on the question, let's start with travel. What's been the standout destination for you in your recent reporting?
Well, it's not so much a destination as a way to get there. This year, I got really into luxury trains, Stephen. I took 2 luxury trains. I went on the Royal Scotsman, which is operated by Belmond, which was just absolutely incredible. And took me through Scotland, which I've been to a few times before, but never through my own train carriage, like sleeping on it, getting to know the other passengers, not having any cell service. It was a real throwback to like an older way of traveling, something really glamorous and really fun. And I also took the new Orient Express train through Italy, which just launched last year. And these are very expensive, but they're also experiences that photograph really well. So bucket list things that just make you see destinations that you know differently through the windows of a train carriage.
Sarah, if I can also mention, you did get married this year.
I did.
But I did see you also reporting on the wedding industry. So first of all, congratulations. And secondly, what did you learn about the wedding industry
They
in
say
your reporting?
right about what you know, right? I got married in September in Athens, in the Riviera in Greece, on the seafront. It was a beautiful day. I learned top tip: things are going to cost more than you think they will. Maybe people know this. Weddings are expensive, but yeah, just have the day you want is what I'd say is important, and figure out what matters to you. For me, I wanted to have a party that went on until 4 a.m, which meant that I couldn't do that in the UK, really, given all the rules and regulations. And I wanted really great food. So like Kate, I love food. It was important to me to feed my friends and family well. So we had it in Greece.
Okay, well, I love those as top tips. Let's turn to some recommendations then for the year ahead. Kate, what are you looking forward to in 2026? Any exciting openings or trends?
It's hard to see because I feel like the sands keep shifting, but because I'm here to say some things that I'm excited about, as we were just talking about, like pubs which have been under pressure in a lot of places. Some of them are beautiful and smart operators are taking them over. The Public House Group is famously doing it in Notting Hill at the Fat Badger, etc., the Pelican. And so this year, Simpson's Tavern is being taken over by the group behind Cloth Restaurant. If you haven't been, it's in the city. It's a fantastic little restaurant. And it's sort of British food with great wines. And now they're taking over one of the storied properties that's also in the city, conveniently close to Bloomberg offices. That's going to be really exciting. I think that's a huge, big opening. Also, Jeremy King, who's one of the legendary restaurateurs in our time, is finally going to reopen Simpson's on the Strand, speaking of throwbacks and trolleys and stuff like that. And so those are places where I plan on spending a lot of time. There's also, as I'm seeing right now, like a really fun Vietnamese food trend coming, and that food is just delicious. It's fresh. It's the kind of thing that relies on a lot of herbs. It's restorative. This awesome restaurant just opened on Paradise Row off Bethnal Green called Tempo. The chef has been doing pop-ups. He used to be in finance, but now his time is much better spent cooking in the kitchen, and he makes just this shrimp toast that's extraordinary. And it just opened, so everyone should go there.
Sarah, when people ask you what they need to see in the next year over the festive period, what will you be recommending? What highlights are you looking forward to?
Well, I'm really excited about Cynthia Erivo, who we all know from Wicked, but she's also British and was first came to people know her as a stage actress, is back on stage in Dracula. It's a one-woman show by Kip Williams, who did the Dorian Gray with Sarah Snook, which won all these Tonys and Olivier's. And that starts in February, and I'm really excited about seeing that because she's just a sensational talent on stage. She's amazing. There's a new Tracy Emin show. It's a full retrospective of her career. It has the famous bed. There's 90 other pieces at the Tate Modern from end of February as well. So it'll be a good one to take people to who are visiting.
And just on the question of travel for you both, if we're thinking a little bit further ahead into the year and destinations of where we want to go, where will you be recommending, Sarah, in terms of a travel destination?
Sardinia is having a moment. A lot of luxury new hotels opening there. There's a new Belmont, a new Mandarin Oriental. But it's also a great part of Italy that just doesn't get enough attention. Beautiful beaches, amazing food. It's also known as the Blue Zone, where people live longer because of that Mediterranean diet. So, can live longer on your next holiday and enjoy great Italian food, some nice red wine and the beach.
Any dining destinations, Kate, that you'll be very keen to check out in 2026?
I mean, I want to go everywhere, of course, because this is a kind of time when food, like you can find something fun almost everywhere you go. Not almost, everywhere you go. I got to go there last year, and I actually cannot wait to go back. Taiwan, and specifically Taipei, is just booming. It's the place that bubble tea was created, so everybody knows it for its very fun drink. It's also the soup dumpling kings. Din Tai Fung come from there, so they know their way around some really good dishes. But they have some cool hotels have been opening. The Capella opened this beautiful hotel, and now it's a really good time to explore their food because they mix up this sort of sultry, old school kind of cooking and food stalls with some really modern, smart, innovative restaurants. And as happens in some of these places, it's if you go to a 2-star, 3-star restaurant, it's cheaper than if you tried to do it in a place like Europe, or certainly the US. It's definitely a couple $100 cheaper. So it's great to go to a city like that and experience cuisine from high to low.
Plenty to inspire us for the year ahead. Thank you to you both, our Bloomberg Pursuits UK correspondent Sarah Rappaport and food editor Kate Crader. I'm Stephen Carroll in Brussels. You can catch us every weekday morning for Bloomberg Daybreak Europe starting at 6 a.m. in London, 7 a.m. in Brussels and 1 a.m. on Wall Street. Nathan?
Thanks, Stephen. And coming up on Bloomberg Daybreak Weekend, we look ahead to how interest rates in Australia could be impacted in 2026. I'm Nathan Hager, and this is Bloomberg.
I'm Barry Ritholtz, inviting you to join me for the Masters in Business podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market. Whether you own stocks, bonds, real estate, commodities, crypto, you really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. The Reserve Bank of Australia looks set to pivot to interest rate increases in the new year. For more on that, let's get to Bloomberg's Doug Krisner, host of the Daybreak Asia podcast.
Nathan, inflation in Australia has accelerated in the past few months, and right now the markets suspect there is a chance that RBA Governor Michelle Bullock may raise interest rates in February of next year. The swaps market right now is indicating a 1 in 3 probability of a rate hike at that time. For a closer look, I'm joined by Bloomberg economist James McIntyre, who joins us from our studios in Sydney. James, thank you for being here. So at the RBA's December meeting, the cash rate, as we know, was held steady at 3.6%, and some in the market may have been somewhat surprised by that. We now have the benefit of the minutes from that meeting. How would you summarize them?
It shows that the central bank is grappling with a bit of an inflation surprise from some of the latest data. So we got third quarter CPI data, and Australia now has a new monthly CPI that's begun to be released. And both of those were a little bit hotter, and it did suggest on the monthly one that it's going to take the RBA some time to get used to this data, but their initial read was that it could be showing some upside risk in December. And so that's really allowed them, with a still hot labour market, to kind of take this little bit of a step back and go, well, we've eased 75 basis points so far, but it's showing that the discussion at this meeting was like, okay, well, maybe we might have a bit more inflation being a bit more persistent and stickier than we like. What would we need to see if we were going to think about hiking next year?
So I'd like to look at the chance of a rate hike in February from the point of view of the market. We recently spoke with Amy Shea Patrick. She is head of income strategies at Pendle Group in Sydney. Let's listen to Amy react to the idea of a rate hike in February.
I don't feel strong enough to put a trade on for February at this stage, but I would argue that the RBA is definitely waiting for the trim mean data. I would argue that there's even further room to look to wait a little bit longer, because some of the blips that we've been seeing coming through our inflation data, when I think about it, it's to do with the timing of subsidies coming off. But when I think about the trends in wages that you see in Australia, and the reason as a central banker you'd really worry about inflation getting out of control again in your country is if you see signs of any spiral happening, right? Whether it's expectations into actual inflation, whether it's wage pressures into actual inflation, none of these things are happening in Australia. So if you even do get a, let's say, 1% trim mean quarter on quarter, there might still be room to wait beyond that. If I had to put a trade on, I would probably still lean against not February for the first hike, if indeed any hikes next year.
Amy Shea-Patrick from Pendle Group in Sydney, back with Bloomberg economist James McIntyre. James, does Amy have a point that maybe the best option right now is to wait and see?
I think she does. I think Amy is nailed it in my view. It's too aggressive to think that the RBA is going to do something in February. They still, there's going to need to be a lot more information for them to be able to assess whether inflation is going to durably exceed their target band. So the expectation the RBA has is that inflation is going to have a bit of a blip up, and some of it is because of these subsidies that have been removed and the timing of the delivery of them, and that's going to be something that is going to be a part of Australia's inflation story for the next 9 or 12 months or so. Getting used to that for the RBA is going to be extremely difficult. And so I think that leads you to err on the side of caution. If February's too soon, it really does put us in the situation for May. Those other factors that Amy raised about the labour market, wages and kind of wage-driven cost pressures and expectations by consumers of wages running away, she's right. I don't see that. And not only do I not see that now, but my view is that where I see that going is that I see a softening in the labour market, gradually dragging the RBA, not from hikes, but actually dragging them back towards easing. And this being more of we'll see, around the middle of the year that this was more of in my view, a bit of a mid-cycle pause from the RBA with them returning to easing monetary policy again.
So how would you describe, James, the overall economic growth story in Australia right now?
It's how I've described it for a long time. It looks good on the surface, but once you peer under the hood, there's a few things going on that suggest that the engine could be running a little bit better. We've had surprise upside from migration. That's boosted demand. When we look at some of the latest GDP data that we've got, it looks like business investment's strong and businesses are telling us that they're going to ramp up. But when we look at what type of investment they're going to ramp up, it's that same AI investment story that is echoing all around the world right now. Now, not only is that AI growth going to be in business investment that's not going to give us many enduring long-term jobs. I don't see many people working in those closed down data centers with no lights. But the AI and the tech and the data center thing is going to help improve productivity and sort of could soften jobs growth for a whole range of services sectors. So that's something the RBA is going to have to deal with, not only over the course of this year, but over the years ahead. And when they're looking on a 2-3 year basis as to whether they need to pull the trigger on any monetary policy, I think as we roll through the course of 2026, we'll see more of that softening in the labour market being the factor relative to, say, price pressures, which I don't think will be persistent, that labour market data pulling them the same way we see it pulling the Fed into easing again in 2026.
When I think of Australia's economy, I think of those commodity type industries, mining industries. I think of iron ore in particular. How are those industries holding up right now?
Better than expected, Doug. You tend to think of iron ore and coal, and those have been the two big stories for Australian commodities for the better part of the last 15 years. We had a very big LNG investment boom, and that's been very big for us. But over the last 2 to 3 years, it's been very, very interesting. We've seen lithium surge with that price spike, and now with the price spike in gold, we're seeing gold exports. Australia is also the third largest exporter of gold in the world, and so this is delivering a new river of gold actually in terms of export earnings for Australia's economy. And so we've seen the latest update from the Office of the Chief Economist in the Department of Industry, who does our projections for commodities exports, and we've seen an upgrade to those again. So it's actually a continued export windfall on the commodity side for the economy, and And that's really, really good news for the government, who will be benefiting from some higher tax revenues from those and could see smaller budget deficits and helping improve the fiscal situation next year as well.
So if you're upgrading an outlook like that, does that necessarily mean that you're betting on a recovery in the Chinese economy, given the fact that Australia is such a strong trading partner with China?
So what's interesting is that the iron ore story is one of, we'd expected iron ore prices to fall because we weren't thinking, looking at the Chinese economic outlook and the uncertainties there, that, there was some perhaps we're now seen to be overly conservative bias when it comes to what was previously factored into that export outlook. And so now, even with a sort of a steadying as she goes and perhaps some more supportive Chinese policy next year, it does look like that is a little bit better on the iron ore side coming through there. So the surprising resilience, I think, is more the story when it comes to those iron ore prices, and then surprising upside when it comes to those other factors like gold.
You mentioned the labor market a moment ago, and I'm curious about the migration story in Australia, what that may look like now and how you might expect things to change in the future.
So the story for 2025 for migration was that a set of policy measures were put in place by the government to try and deal with a massive surge in migration as students and temporary workers all came rushing back post the pandemic. And so the expectation was migration was going to fall this year. But when we got to the middle of the year, it didn't. And we forgot a factor. We forgot the back door. Australia has an open labour market when it comes to New Zealand. And New Zealand's economy has been struggling and dipped back into recession in the middle of this year. And if there's jobs going in Australia in a tight labour market and it's looking pretty bad at home and you're a Kiwi and the weather is better as well, they've voted with their feet. It's a flightless bird, but the Kiwis have gotten on the plane and have moved quite a bit to Australia, and that's really moved the dial on migration. So seeing that normalise next year is something that from 2026 we think that migration story will step back. But right now it's been one that's added a little bit of a surprise boost to demand within the economy. So that's been one more factor that helps the RBA being a little bit reticent around, do we have too much activity in the economy? Could this inflation be a bit more persistent? Because we haven't had, for sort of firms that are in the consumer side of the economy, if migration was going to fall away and population growth wasn't going to be as strong, those firms might have been a little bit more cautious in their demand outlook and their sales outlook. And if we've had the situation of strength in that consumer demand, if there is any opportunity for them to raise prices, that's a little bit of a different environment, and an environment that the RBA is flagging those concerns about. It's an environment we think will give way to a bit of an easier inflation outlook next year, leading to those cuts as flagged in the discussion earlier.
One of the hot-button political issues here in the States as it relates to the economy is this issue of affordability, and I'm wondering whether that's playing out in a way that is very similar in Australia right now.
It's called affordability in the US. We've called it a cost of living crisis here in Australia. And that's been a hot button issue for the government for the past 2 to 3 years. And we've done everything. We've had a very big, wide-ranging government inquiry into the supermarkets. We call it a Royal Commission. And that really put the heat on whether that duopoly that we have in our supermarket system here was responsible for some of that inflation. In the housing market, it's been a perennial concern, but what the government has done is they've provided additional supports to first home buyers, those that are at the most difficulty of entering the housing market. That will actually, ironically, push up prices even further, or help support house price rises in the parts of the market that first home buyers would be in. But we have been dealing with that here in Australia in different ways, be it either housing, food supply, or when it comes to, and going back to what Amy was saying, and what I was also discussing when it comes to the inflation story around subsidies, electricity price subsidies were put in place as well to try and deal with this. So we've been going through this affordability issue on the Australian context in many, many ways, and it does look like, or at least the expectation is, that inflation should be continuing to ease back over the course of 2026 after a bit of a bump up through the middle of the year. We could see the RBA beginning to be a little bit more comfortable by the end of the year.
Nonetheless, as you were just pointing out, it seems to underscore the dilemma facing the RBA.
Look, it certainly does. And when it is, especially when you have price pressures in high frequency purchase items, if there's things that consumers buy once a year or once in a blue moon, like a new television, courtesy of, say, some trade restrictions or tariffs, if that were the case, that's very, very different inflation to inflation you see at the petrol pump, at the fuel pump, or at the supermarket every single week when you're buying food for your family. And consumers respond very, very differently to those. And so it's something that the RBA has been watching, and no doubt other central banks will be watching as well through the course of the year ahead.
James, we'll leave it there. Thank you so very much. Bloomberg economist James McIntyre. And I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.
This is Caroline Hyde.
And I'm Ed Ludlow, inviting you to join us for Bloomberg Tech, a daily podcast focusing exclusively on technology, innovation, and the future of business.
Every weekday, we bring you the top headlines from the world's biggest tech companies.
From finance to defense, AI to entertainment, and from startups to the Magnificent Seven.
We highlight the latest stories of the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets.
We do this all every weekday, then bring you the most important conversations and analysis in our podcast.
Search for Bloomberg Tech on YouTube, Apple, Spotify, or anywhere else you listen.
Join us every afternoon on your commute home and stay ahead of the tech news cycle.
That's the Bloomberg Tech Podcast. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Subscribe today, wherever you get your podcasts.